uh, here as well, right? So there are two chapters here. There's one on just introducing what solvency capital requirements are, like how it is assessed across the different jurisdictions, right? And the second chapter focuses more than on Solvency 2 itself, right? That's where a lot of questions also come in, that how Solvency 2 works and everything, right? The first chapter just introduced Solvency 2, the pillars of Solvency 2, and how other jurisdictions work. And in the second chapter, they actually talk about one of the key pillars in Solvency 2. Okay, so we'll go over those chapters one by one. Before starting off with that, uh, I just wanted to make sure that we understand what reserving and solvency is all about, right? So reserving was something that was introduced pretty well in SP2, right? We had the GPV, we had unit non-unit reserves, we had a bit about, I guess, negative reserves as well, and there was then this thing about market consistent valuation and active and passive valuation, if you all remember that. So all that was about like how reserves are calculated, right? There was not a lot about how solvency is calculated. It was just introduced as a concept that first insurance companies keep something called reserves, which is nothing but PV outflow minus PV inflow. And over and above that reserve, they keep something called a solvency capital, right? Together, it forms the total capital requirement of an insurance company, which helps them portray the like solvency strength, so as to say, right? Now, today, we'll like in SA2, in fact, they're talking a lot more about solvency requirement, how the solvency of an insurance company is assessed in the first place, right? So uh, the way they have introduced this is they've talked a lot about Solvency 2, right? Which is your the main thing that like main solvency framework that insurance companies in European Union need to follow, right? And according like it's based on risk-based capital, which means that according to the nature of risk that every insurance company faces, uh, they need to hold capital uh, like which is appropriate for that level of risk, right? So it is a capital that basically is appropriate for the level of risk that every insurance company has, right? Can you all see my screen as well? Yes or no?
Yes.
Yeah, cool. So I'll just write down things that I feel needed out here. Cool. So starting out with what's Solvency 2 in the first place, right? So the concept of Solvency 2 was like, why was Solvency 2 brought in the first place? That prior to Solvency 2, you had capital approaches, like capital assessment approaches that were not very like that did not take care of the actual amount of risk that companies overtook, right? So Solvency 2 aims to improve the risk management technique. That's number one. Because of that, it also helps to protect policyholders, right? And it also then helps all insurance companies in the Europe adopt a uniform regime, right? So and then it also helps you to keep up a level of capital that is appropriate for the level of risk that you hold. Okay. Now, the authority that's responsible for this is that like that like developed this solvency to in a way is EIOPA, okay, which is the European Insurance and Occupational Pensions Authority. So what is this? This is the Euro Insurance and pension and um, occupational pensions authority. Now, why is occupational pensions like taken into account along with insurance is because of the nature of products that are sold in Europe. In Europe, you'll see that like occupational pensions are very common. So there are a large number of pension schemes who look into um, distributing pensions, right, to employees, and that's why occupational pensions are also looked at along with insurance, right? Now, and this applies to any insurance company who have their premium income greater than 5 million euros or who have their reserves which is greater than 25 million euros, right? Again, the specifics of this are not as important. What we need to understand is how is this, how does this, uh, like, um, take into effect what is the structure of Solvency 2. Okay, so the structure of Solvency 2 can be uh, talked about where by splitting it into three main pillars. Okay, so there's pillar 1, there's pillar 2, and there's pillar 3. So there are three pillars in solvency cap, like when talking about the Solvency 2 framework. The pillar 1 is talking about your quantitative measures, okay, all your quantitative requirements. The second one is about your qualitative requirement, okay. We'll come to each of them, what each of them stand for, right? So the second one is qualitative, and the last one is the actual reporting and disclosure, okay. So for example, you all would have heard about these things, right? Solvency ratios, uh, calculating them, meeting the minimum capital requirement, meeting the solvency capital requirements, calculating, looking at your balance sheet and doing that, right? So all of that comes under quantitative, right? Say calculating MCR, SCR, right? The approach used in Solvency 2 is uh, risk based, right? So it's based on MCV, which is market consistent valuation. So we have talked about these terms before, right? So we'll revisit them today. Yeah. So quantitative pillar 1 is about calculating those things. So uh, like purely technical, calculating the numbers, right? Then the qualitative part, the like pillar 2 part is where you have something called a ORSA. We'll talk about this, which is nothing but a own risk assessment, and that forms a part of ORSA, right? Own risk and solvency assessment, where they produce a sort of a qualitative assessment whether they their solvency capital requirement is the whatever they have calculated here, how that is helping them to meet all the risks. So they list down all the risks that they're exposed to, right? Then they list down what are the risk management controls that they have put in place, okay? And then how is the MCR, SCR that they have qualitated in pillar 1 sufficient to meet those risks, okay? So this is a review process, it is a governance process, it is a risk management process, okay. So pillar 2 includes three things, right? It's a review process that you're making sure that what you have calculated is enough. For that you have a risk management system in place which is called the ORSA, right? And you have this governance, ongoing governance to make sure that it is enough as well. So it's a review and governance where you are taking a, like, looking at your own risk, identifying what are the risks that you're exposed to, making sure what are the uh, like risk management practices that you have adopted, whether they are still relevant, and then finally producing this ORSA. Is the distinction between pillar 1 and 2 clear, guys? Yes or no?
Yes, sir.
Yeah, cool. Now last one is where you are doing the actual reporting and disclosure thing. So uh, as we know, when you're reporting to the regulator, there are quite a number of disclosures that you need to make. For example, under like Solvency 2, there are a few like disclosures that you need to make to the regulator, which involves, say, these MCR, SCR, whatever you have calculated, the ORSA reports, what are the risk management uh, like things that you have adopted for your company, what are the those fit uh, things that we're talking about, that how are your auditors fit, how are your people fit, those things, what are the internal risk uh, cultures in the insurance company, everything forms a part of those reports. So there's a defined set of reports that you need to submit to the regulator on a periodic basis, and that forms a part of pillar 3. Okay, so pillar 1, quite quantitative in nature, specifics about calculating MCR, SCR, minimum capital requirements, solvency capital requirements, basically whatever you need to hold over and above those reserves in Solvency 2, that is based on the what? It's based on market consistent valuation. Okay, What is it based on? It's based on market consistent valuation. So it's risk based capital. You are looking at your uh, like risk-free rate of return. You have something called a liquidity premium that's based on the kind of assets you're holding. So all those things we'll talk about in the next chapter, where pillar one is talked about in um, detail. Then you have got pillar two. Okay, pillar two is more about the qualitative reporting. You list down these are the risks that I was facing. Like you then explain what were those risks. You then get to what are the risk management techniques you have adopted, right? What is your review process? So that becomes a part of a report called ORSA, which is Own Risks and Solvency Assessment. Finally, the actual reporting and disclosure to the regulators. So there's a defined set of report submissions that you need to make for solvency, and that's what Pillar 3 is all about. Okay? Yeah? So far, so good. Any questions? Cool. Now we'll focus on this pillar 2 and pillar 3 in this chapter more. Okay. We'll break down what are your pillar 2 things. Okay. So pillar 2 is can be mainly split into two parts. Okay. So when we are talking about pillar 2, we can talk about first your governance requirements. Okay. And the next one is ORSA that we have been talking about. Okay. So governance requirement is basically what are the roles and responsibilities within your business. Okay. And the overall responsibility Solvency 2 stays finally rests with the board of directors of any insurance company. Right. So they are saying you should have an organization structure such that everyone's clear of what their responsibilities are, right? Their responsibilities are clearly defined in the pillar 2 framework, right? And there should be an audit function. There should be an audit of almost every function, right? There should be an internal audit within an insurance company of every function, right? So for example, if I'm performing a task, my my task should be internally audited by some other function within the insurance company, right? That is where you will see a lot of these big insurance companies have something called a first line and the second line of defense. What does that mean? So you'll have, say, a reserving department, right? The reserving department would be where the actual reserves are calculated in the first place, right? And then you have the second line of defense, which means another risk management, say, department. Those risk management departments audits whether the reserves that are held are sufficient or not. Correct. So you have multiple lines of defense, right? Then they say the actuarial function within this insurance company are primarily responsible for calculating reserves, right? And they are the ones who are responsible for explaining any changes, right, in those reserves. Now, remember we have talked about things called analysis of surplus when we were in SP2, right? So analysis of surplus is what? Whenever there's a change in reserves, you need to explain that, right? That change in reserves can be of multiple sources, right? It can be because of, say, change in data, change in assumptions, say, change in modeling methodology. So you need to look at all of them, and the actuary's responsibility is to explain all of them. Does this make sense? Sorry, guys, just give me a moment. I'm getting a call. Just a minute. Sorry, guys, apologies. Where were we? We were talking about the internal solvency to governance requirements. So basically, what the governance requirement is of, you imagine an insurance company to work efficiently, right? That it has appropriate management, board of directors function in an appropriate manner. You have a first line of defense that's calculating reserves. You have a second line of reserve defense that's auditing those findings, right? Then you have the actuarial function that's making sure that the amount of reserves is correct. They are explaining the movement of the reserves correctly. That's where the function of the appointed actuary also comes in. So that is all laid down in this governance requirement. Nothing like more special than that, but just a more fancy way of putting it out. Does that make sense? Governance requirements? Yes or no?
Yes.
Yeah. Answer all good?
Oh, yes, sir.
Yeah. Cool.
Yes.
So the first one is your like to do the governance requirements, right? So you should have an actuarial function, you should have a compliance function, a risk management, and audit, internal audits, everything, right? One more thing that becomes a part of governance requirement that we have not talked about yet is something called an internal model. Okay, something that we'll talk about when we are also talking about when we'll also see this pillar one. Okay, so when you are calculating this MCR and SCR, regulator has provided insurance companies with couple of options. One option is that you use a standard model that the regulator has prepared for you. You just give your inputs parameters there, and the model spits out the MCR or the SCR. Or if you are a big insurance company, a big reinsurance company, they've given you the flexibility. Prepare your own, like develop your own internal model, get it approved by the regulator, and you can use that. Right? So an internal model is something that's internally developed by the insurance company. So a governance requirement will also involve specifying how the internal model works. Okay, so like why is the internal model being used, right? And how is it taking care of all the risks while calculating the capital requirement? That is also something that's explained in the governance requirements. Does that make sense? Yes or no? Any questions? Cool. The next part of it is ORSA. So ORSA is about what? You need to carry out an own risk and solvency assessment. That is what ORSA is about. So every company looks in within itself, sees what are the risks it's exposed to, makes an assessment whether the solvency capital that they're holding is sufficient for that level of risk or not. Right? So they've given a particular line of like definition uh, about the OSA here, as what the EOPA defines it. It says that I'll just quote that on verbatim. It says that the entirety of the processes and procedures employed to identify, assess, monitor, manage, and report short and long term risks an insurance undertaking faces or may face, and to determine the own funds necessary to ensure that the undertaking's overall solvency needs are met at all times. So what they are saying, it is basically all the process and procedures that you have employed to do what? To identify, assess, monitor, manage, report. A lot of words, basically making sure that you know all your risks, you properly know what are the different things you have adopted to counter those risks, right? To list down those risks, to manage those risks, you have basically made sure you have employed all the techniques to do that. What kind of risk, both short term and long term risk, that you are facing right now and you can face in the future. So all those kinds of risks. And also making sure whether whatever capital you have right now, whatever funds you have right now, whether that is sufficient to meet your overall solvency need. So two parts, like we were discussing, risk assessment and solvency assessment, right? So ORSA explains, this document explains what? This explains two parts, right? It explains risk and solvency assessment. Okay. It is an assessment of these two things. Okay, risk assessment, we understand what that means, right? You just list down all your risks. How are you planning to like monitor them? What is your management strategy? what are short term, what are long term risk, what are you currently facing, what's the degree of each of this. That's what risk assessment is about. Solvency assessment, right? Whether you will be able to meet your MCR, SCR, how are you meeting them, what is the level. So basically you are explaining in a way pillar 1 in qualitative language, right? One more thing that uh, ORSA is also about is like at times, if at that this point of assessment, when they are doing this qualitative assessment review process, they feel that this SCR is not enough for the level of risk that they're holding, they can also add on an extra layer of capital, which is called an add-on capital, right? So the supervisor, whatever is the regulatory authority, they can look at the ORSA, they can feel that whatever level of SCR that this insurance company has calculated, that is not enough for the level of risk that they hold, and they can also suggest them to hold an add-on capital. So that adds on to the existing SCR of any insurance company. Does that make sense, guys? Any questions?
Sir, is this like review process or where we
Hmm.
are calculating the solvency and risk, is it like an
Yeah.
ongoing process or
Yeah, it's an
it's
ongoing process. So you have quarter, depending on your size, you might need to do quarterly or an annual submission to the regulator.
okay.
Yep.
So
And yep. Good.
so like pillar 3 is all about reporting
Right.
for
Making those submissions, right? So making those submissions will be a quarterly or annual process, right?
hmm, okay.
Solvency 2 can be based on anything. Like it's basically internal for the insurance company, right? So they might want to do it on a more frequent basis as well, based on how like live are their dashboards and KPIs. But
Okay.
based on that, they can basically have a very live review process as well, right? At the end of the day, an insurance company knows what is the level of assets, liabilities they're holding, but
Hmm.
because of the sheer size, a lot of moving pieces, it's very difficult to do that valuation on a live basis. So they do it on a quarterly basis. Reporting, however, can be either annual or quarterly.
Okay.
Yeah.
Okay. Yeah.
Okay. Seems good, guys. Any questions so far? Cool. Coming to the last pillar, the third pillar of solvency, it is about the supervisory reporting. Okay. Now, when it comes to supervisory reporting, there are two kinds of reporting. Okay. One is the private form of reporting, right? And other is whatever you disclose to the public as well. So there are two main forms of reporting, right? A private reporting and a public reporting. Okay. Now, when it comes to the private reporting, which does not need to be made like public uh, to the wide population, what is that? That involves something called the RSR, which is what? Regular supervisory report. Okay, what is it called? Regular supervisory report. This regular supervisory report must be submitted annually. Okay, so it has a like periodical thing attached to it, that you're submitting this regular supervisory report at least annually. Okay, what does this RSR has? This regular supervisory report that has two things. One is the qualitative information. Okay, qualitative information, basically what you have found out in like uh, uh, the pillar 2, that, and the second one is QRT, a lot of abbreviations again, but this is what? Quantitative reporting template. Okay, so there's a template that um, the authority has come up with, the EOPA has come up with, the ORSA authority. They say that you need to just fill up this template, and that will have things like, say, what is your balance sheet, what are the assets that you hold, what are the liabilities that you failed, what are the lines of businesses, what are the premiums, claims, expenses for different line of business, what are the reserves, what are the the insurances that you have taken out, your SCR, MCR, everything. Okay, so that template will have all those things. Does that make sense to everyone? Yes or no, guys?
Yes.
Yes,
Yeah,
sir. And so the qualitative information would be what all review process we have done and how
exactly.
risk.
Whatever we talked about in uh,
Oh,
uh, pillar 2.
Okay. Okay.
Okay. Then you have the public disclosure. Now, public disclosure is sort of like a part of it is voluntary, a part of it is compulsory. So there is a public report similar to the RSR. A public report that needs to be produced in the European Union is called the SFCR. What is the SFCR? SFCR is Solvency and Financial Condition Report. So there's something called the Solvency and Financial Condition Report, that is SFCR, that needs to be produced publicly. Okay, and that is nothing but some part of RSR. Okay, so they can pick up portions from qualitative and QRT and put that in the SFCR, but at times insurance companies voluntarily like disclose more information to the public. Yeah, any questions so far?
So
Mm-hmm.
private reporting would, like, public would be for normal people and government, and
Exactly, for all
regulation,
stakeholders.
and the private would be for.
Private is only for the local regulator that you are reporting to.
So, like,
Okay,
the regulator will not have access to the public information.
public, everyone has information too. So like public will be a subset of the private. So if private has
Oh,
information 1 to 100, public will have information say 2, 10, 5, 12, something like a subset of that.
okay, okay, okay,
Yeah, now public is basically available, like it's it might be a part of your annual reports, right? It might be that public. So you need to, that's your minimum disclosure to the public, to your all your stakeholders, to your employees, to your shareholders, to your debtors, to your creditors, everyone, right? To your policyholders. That is your public disclosure. And private is something more that you need to submit to the supervisor or to the regulatory authority to make sure that you are in a fit state to operate. Okay?
okay.
Yeah. Cool. Now comes the interesting part. Okay. Which is what are other problems that Solvency 2 also takes care of. Now, one of the very interesting portions here that we are talking about is something called the group reporting requirements. Okay, this is something a lot of the big conglomerate insurance companies face today, and like it has to be tackled as a part of Solvency 2, and that is what group reporting. Okay, what do I mean by that? You'd have heard about companies like Prudential, companies like AIA, right? Companies like Aviva. They have like a lot of branches, so as to say, a lot of other entities selling business in a lot of jurisdictions. For example, Prudential, Aviva, they are mainly British companies, right? Companies originated in the UK. But you have a lot of joint ventures or even wholly owned subsidiaries of the group company that sells business across the world. So in India, Malaysia, Southeast Asia, China, even the US, right? So you have got these companies selling business all across the world, right? So how do they report to their home authority? For example, Prudential in UK. And how does Prudential report in, say, India, say in Malaysia, say in China, right? So the regulation says that as a group, insurance group, it must cover first the overall group SCR. So if it forgets about the boundaries, that it is different legal entities, and thinks of it as one big group and takes into account all the diversification benefits between those different groups, and then calculates the overall group SCR. So first, the insurance entire group must cover that. Now remember, the group here is not a single legal entity. It is multiple legal entities. It is Prudential. It is can be Prudential Ireland. It can be Prudential Germany. It can be Prudential Southeast Asia. It can be Prudential APAC. Like a lot of legal entities together form a Prudential group. Their overall group SCR that needs to be met. Number one. Number two, your group solvency floor, okay, which means if you look into every legal entity, they have their own SCR, MCR, right? So you take the sum of all their MCRs, right? Or the local equivalent, which means, for example, today in India, you don't have the Solvency 2, right? You have something else, right? So you calculate their minimum capital requirements according to the Indian solvency regime. China has its own. So you calculate the Chinese CROS, which they call it, their minimum requirement, right? You take a sum of all those requirements. That needs to be met by the group as well. Okay, so group, the first motive is to calculate two things. The overall group SCR, where you consider everything as a single legal entity, take into account every diversification that, and within the first, there is one more thing, that sum of SCRs across all uh, all like entities, right? So this is the first requirement. The second requirement is that every subsidiary individually also covers its own SCR and MCR. Okay, so these are the two requirements for group reporting. Okay, does this make sense to everyone? So everyone individually has to meet their MCR, SCR. You think of everything as a group, as one single legal entity, take into account diversification benefits that needs to be met by the group. The group also needs to meet what? Sum of all MCRs. Does it make sense, guys? Any questions? All good?
Yes.
Yes,
Yeah.
sir.
Now, there is one logic called equivalence that is important for us to understand at this point of time. Why? Because today, Prudential working in the UK, Prudential working in India, there, uh, these two jurisdictions have completely different capital requirements, right? So whether this regulatory regime is being recognized by EIOPA, by EU, and that is being like India's solvency requirement is considered to be enough or appropriate by an EU is a question mark in itself, right? So this is where the concept of European Economic Area comes in. So EU, all members of the EU, European Union, are a part of the European Economic Area. Everything that's apart from it, any third country needs to make sure that their solvency regime is equivalent to the solvency regime in the EU, which is the Solvency 2. Only then will be they granted this equivalence tag. Why is this equivalence tag important? This equivalence tag is important because then that local legal entity will not have to calculate the MCR and SCR based on Solvency 2 when doing group reporting. Okay, so that legal entity in India right now for Prudential will have to do local reporting to the Indian regulator, will have to do group reporting to the UK regulator. Now, if the Indian solvency regime has the equivalence tag, then that local reporting number will be also accepted when calculating the group reporting. So it won't have to do the calculations again. The group won't have to do the calculation again, right? But for the equivalence tag to be there, they have to be quite similar. It should be similar to Solvency 2, right? It might not be possible that, for example, in India, you have a completely different factor-based approach, which is not based on risk-based capital. So India doesn't have an equivalence like tag, right? But for example, say Australia, that has a risk-based capital being calculated. Uh, they have the provisional equivalence tag. So this equivalence can take different forms. One form is full. Full equivalence means that you've got to equivalence for life. Given you don't change the regime, it will stay equivalent. The other can be temporary. For these many years, you have got the equivalence. After that, you need to renew it again. Okay. And the other one is provisional. Okay. So there are three equivalences, just like very like it's a mix of political and what do you call national power thing that comes here. But like these are tags that they provide to other solvency regimes. Yeah. Again, they don't usually ask direct questions about equivalence, but they quote it in questions. So it's important for us to know what these concepts are. So far, so good about group reporting. One of the issues that Solvency 2 seems to have solved or tackled using this equivalence tag. Tell me, guys.
The third one you tell the solvency regime as applied to reinsurance activities is equivalent. What does that mean?
Where exactly? Sorry.
This the equivalence can be
Okay.
granted in
So
three different
what they're saying is uh,
uh,
that when you are looking at a reinsurance activity, it is
mm,
considered as insurance. Okay.
mm,
So that is something that IFRS 17 also considers. So IFRS 17 does not differentiate a lot between insurance and reinsurance. Insurance is between a company and a policyholder. Reinsurance is between two companies, and they consider the reinsurer to be the insurance company and the other cedent or the insurance company to be the policyholder,
mm,
right? And
mm,
then they like write out all the rules in that format. That is what IRDAI have also done. They just take up the insurance regulations, copy paste them, change
mm,
policyholder to cedent, insurance company to reinsurer, and that has become the reinsurance regulation. So
mm,
that's a common practice that whatever solvency regime is applied to insurance activities is also applied to reinsurance
mm.
activity.
Exactly. Mm, okay.
Yeah.
Mm.
All good, guys. Any questions so far? Cool. The next point that they're talking about here, Solvency 2, is the effect it has on the business culture and strategy. So what like this Solvency 2 says is that the long-term uh, the long-term impact that they want to have it, that every company has its own risk culture, right? That the senior management, the board of directors, everyone thinks in terms of the risk that the companies pose to, and then take steps according to that, right? So the main impact that you're trying to have is trying to integrate that risk culture into every insurance company, that they try to think in terms of market consistent terms, right? Because historically all these insurance companies have say been on a US cap basis or on a basis that has locked in assumptions that does not update as well on passive valuation assumptions, right? But Solvency 2 and IFRS 17 along with that also given a good push, has pushed all these companies towards a market consistent valuation or a more active form of valuation, right? So they want to integrate a sort of a risk culture into every insurance company, that they try to look at their capital, look at their own practices on a daily basis in terms of the risks that they introduce into the process, and how do they want to manage those risks. If they're introducing those risks, what is the additional amount of capital they are holding, right? So they want to integrate that culture into every insurance company, right? That there's a good risk management framework. You correctly allocate capital between different lines of risk, right? You have risk mitigation techniques in place. You are properly documenting them, right? It not only that, it impacts how you are treating your customers, what kind of business you are selling, what kind of places you are making your investments, right? Like what, for example, what is the sort of business you are selling? If you want to sell annuity business or term business, what is the proportion of like what is the product mix that you are like looking at, right? So all of those things, all of uh, these things they want to influence with the help of Solvency 2, right? That companies are more conscious about the level of risk that they are taking, right? And are able to integrate that in their daily decision making. Does that make sense? Any questions?
No.
Yeah. Finally, they say that there are some statutory roles that Solvency 2 introduces. One of the chief actuary in the UK, right? This chief actuary does nothing but is responsible for overlooking the entire Solvency 2 process, like making sure whether there, like whatever we talked about, the appointed actuary yesterday. Basically, everything applies to them. Whether uh, the reserves are fine, then whether the solvency capital is fine. If reserves are fine, they need to talk about data assumption, modeling methodology. right? They need to write an overall report where they're expressing whether the amount of reserves and solvency capital is enough or not. So that introduces a statutory like position in the form of a chief actuary. Does that make sense to anyone? Any questions, guys? All good? Cool. Uh, Now, in the next part of the chapter, they're talking about different regulations, different jurisdictions. So, in the first part, they're just talking about UK. They've brought in a lot about EU and how uh, they EU and the UK are following Solvency 2 now, right? I think they're following this onwards 2021, right? And they have a transition arrangement in place as well for people who are transitioning from a previous regime to the new regime, right? The next one is about US and China, right? So US and China have things that are quite similar to uh, the Solvency 2 that we have talked about. So US also has in place a risk-based capital regime. Okay, so it has a standard formula based on which people need to calculate their capital requirement. It is a part of the disclosures as well. There is something called the NAIC there, National Association of Insurance Commissioners. That you can think of it like US's IRDA, right? They are the ones who are, in a way, that they are not direct regulators, but they act like the regulator. Why? Because in US you have 50 states. Okay, each state has its own local insurance department, a state insurance department. But NAIC is like that national thing that tries to bring uniformity in the regulations and how like everything's meeting between every state. Right, so it is not a binding authority NAIC as such, but still it still has like a very large influence, right? But uh, getting back to the point, here as well, you have a risk-based capital. Your reserves uh, till lately were calculated at locked-in rates, but with the move to IFRS 17, you again have BEL, RA, and CSM, right? And then you have a modernization initiative here, which comes up with PBR. Have you all heard about PBR? Tell me, guys, have you heard about this PBR thing? If you've worked on US markets, you'd have heard about PBR, which is nothing but principal based reserves. Okay. So what happened in US first was they had a very locked in a US cap, right? US cap, and then they also had LTDI, which is a more modified form of US cap only. But the funda there was that you calculate reserves on locked in assumptions, right? So it's a passive form of valuation. Only your economic assumptions used to change over time. But PBR brought in the thing that you need to hold reserves according to the amount, like risk your business has, right? So it had a formulaic approach to like calculate your reserves, right? Uh, so it had three kinds of calculations. You had a net premium reserve, then you had a deterministic reserve, and you had a stochastic reserve, right? PBR is again state based, right? So it is not same for every state. Like I said, there's no consistent regulation across all 50 US states. That's a very big problem in US when it comes to insurers, because they need to tackle with a lot of regulations, right? So PBR came in effect, I think, in 2017, and onwards that they need to calculate principal based reserves. Okay. Does this make sense, guys? Any questions? All good. But now, like, because of the introduction of RBC in the US as well, a lot of the total capital requirements is very similar, right, between the EU as well as in the US. Okay, so it brings both of them at par, right? China has a very similar framework to Solvency 2. This framework is called the CROS framework, cross framework, right? The CROS is nothing but your like Chinese authority has come up with CROS, and that is compatible with, in a way, the international standards and everything. So like the your what do you call Solvency 2, it also has three pillars, one quantitative, other qualitative, and then a pillar 3, right? So CDOS also has all those three pillars, and it needs to calculate uh, according to Chinese, all Chinese insurance companies need to follow that. Okay. Then they have talked about Australia. Australia also has a risk-based thing. Their authority is called the APRA. That APRA is responsible for calculating, like laying down what is the capital framework. Right there, you have something called a PCA, prescribed capital amount. Where, if you remember, we talked about this in SP2 as well. You determine reserves, like capital requirement at a 99.5% VAR, right? So that is what the APRA suggests. Something that we'll also talk about in the next class when we are talking about pillar 1, right? So the like the large logic being that mostly all of the countries now are moving towards an economic capital, right? Or towards a capital that correctly reflects the risks you are holding, right? For example, India is still based on a formula thing, but it's trying to move towards a risk-based capital or an economic capital that more mimics Solvency 2, right? So all companies are, all regulators, jurisdictions are slowly moving towards it. But the only problem is the moment you shift towards risk-based regime, it raises your regulatory costs for an insurance company, right? And regulators don't want to do that in developing markets like India, right? So they are a bit hesitant to do that. They are doing it in small baby steps, right? But all regulators are eventually getting like moving towards that. Does that make sense, guys? Any questions? Any doubts? We'll talk about this pillar 1, exactly the formula that is used to calculate MCR, SCR the next weekend. We'll try to get done with that on Saturday itself. And we can close the solvency assessment. Again, this is one of those chapters that's important from the point of view of exams. A lot of questions in SA2 come from this portion. So if you have any doubt, please feel free to like ask in the next class. And I would also suggest you to maybe read up to chapter 9 in this time. Because the moment we are done with chapter 12, 13, we'll be done with close to what? Actually, we are done with close to 50% of the syllabus now, but it would be good if we all can give it a quick read as well. Any questions, guys? Tell me.
Nothing as of now, sir.
Nothing? Cool. In that case, I'll close for now. Thank you, everyone. Bye-bye.